If you've ever wondered why some options are cheap and others are crazy expensive, why a Tesla call might cost $10 while a Coca-Cola option costs $3, the answer is volatility. Not direction, not momentum, volatility. In this video, I'm going to show you how this one concept literally determines the price of an option and why understanding it is the key to making money as an option trader. Now, if you want to run a profitable option selling strategy, you must understand the concept of volatility. This isn't just some technical term. Volatility is literally the foundation of why option trading as a strategy exists. Options were literally invented to trade volatility. And once you understand this, you will start seeing the market in a completely different way. So let's break it down. In trading, the definition of volatility is how much a stock moves. Not what direction it moves, but how big the moves are. A stock could literally jump 10%, come back down 10%, and even though the stock hasn't moved at all, we would still say that that's very high volatility compared to how much stocks normally move. On the other hand, there could be a stock that moves 1% every single day, but in the same direction. And over the course of a year, the thing has literally tripled in price, but it's done so at a very low rate of volatility. So the key idea here is that volatility is not the direction that something moves, it's the size of moves that it experiences. So let's make this real. Coca-Cola is a calm, stable stock. Over a 4-day window, the moves might look like -1%, +1%, -1%, +1%. Now, on the other hand, a company like GameStop might look like +9%, -10%, +15%, -8%. And the answer is pretty obvious here, but just looking at them, you can tell one is pretty boring, and the other is crazy amounts of excitement and movement. So just take a wild guess as to which one would have more expensive options. If you guessed GameStop, then guess what? You are absolutely correct. Now imagine that both stocks are trading at $100. Given how much we know Coca-Cola moves and how much GameStop moves, we might see that the Coca-Cola option trades at, I don't know, $3. And for that same time frame, what do you think that GameStop option might be trading for? But on GameStop, that same strike call option might be trading for $20 instead of $3. Now, why might this be the case? Because the more a stock might move, the more potential that an option has to end up deep in the money. The reason that the option price would be so much higher on GameStop is because the market tries to make it be a fair bet for the buyer and the seller. If we looked at GameStop and let's say it was trading at $100 just like Coca-Cola, and that option was also $3, it would be an absolute no-brainer to purchase that option because we know that in any single day, this stock is moving 10%, 15%. All we need is one move up for a day, and this option is literally going to be 3 times its price intrinsic value. All we need is a normal one-day move to the upside, and this option is going to triple in value. So it doesn't make sense that the GameStop option would also be trading at $3. The expected volatility for GameStop is so much higher, and therefore it needs to be reflected in the price of the options. Now here's the part that most traders miss. The price of an option tells you how much movement the market expects. And when you sell an option, you're selling that expected movement. You're basically saying, I don't think the stock is going to move as much as the market thinks it will. And if you're right, you get to keep some of the premium you collected. So when you start shifting the way you view the world of options and start thinking about it through the lens of volatility, everything changes. You stop simply asking, will the stock go up or will it go down? And you start asking questions like, how much will it move? And is it going to move more or less than what the market implies? And that shift in thinking is what separates serious option sellers from the rest of the gamblers. So let's do a quick recap here. Volatility is the size of moves, not the direction. Option prices are based on how much volatility the market expects in the future. And when you sell options, you're betting that those expectations from the market are actually too high. There's actually a concept, which is the first thing we cover in the Predicting Alpha Masterclass, which you can get free access to, by the way, clicking the link in the description below. And that concept is called variance risk premium. It's the reason that option selling as a business actually makes sense and is something that's actually been done in the professional space for decades. Understanding volatility, understanding variance risk premium, these are the reasons that professional traders are able to consistently make money selling options. It's not luck, it's math. And it all starts with understanding volatility. So if you're serious about selling options, learning volatility isn't really an option. It's a crucial part of the game. And on this channel, all we talk about is volatility and selling options as a business and treating your option selling like a business. So if you like this video, like, comment, subscribe, leave a comment below, let me know what you think, and I'll see you in the next video. Take care, everyone.